The current date is Sunday, March 22nd, 2026, and the time is 5:59 p.m. Since the market is closed for the weekend, I'm providing the final closing price from the most recent trading session on Friday, March 20th, 2026. At the closing bell, SoFi Technologies finished at $16.90, marking a decrease of 1.05% for the day. This price action capped off an incredibly volatile week that saw the stock whip between a high of $17.41 and a low of $16.67. While a 1% drop might seem like a standard Friday fade, the reality under the surface is far more complex. Most investors looking at the ticker right now see a fintech company that has lost nearly 43% of its value over the last 6 months, but what they're missing is the massive tug-of-war happening between institutional heavyweights and a high-profile short seller. This isn't just about interest rates or student loans anymore. It's about a fundamental disagreement on whether SoFi is a legitimate banking powerhouse or, as some critics claim, a financial engineering treadmill. Expectations for SoFi heading into 2026 were sky high, with many believing the company would finally decouple from the volatile fintech pack and trade more like a diversified bank. The reality, however, has been a brutal lesson in market sentiment. Just days ago, on March 17th, Muddy Waters Research dropped a bombshell short report alleging that SoFi has roughly $312 million in unrecorded debt and is using aggressive accounting to inflate its adjusted EBITDA by nearly 90%. While SoFi has vigorously denied these claims and threatened legal action, the damage to the immediate stock price was clear. However, here is the part that should grab your attention. While the retail crowd was panic selling, CEO Anthony Noto was doing the opposite. He recently put his own capital where his mouth is, purchasing approximately $500,000 worth of shares in the open market following the report. When an executive buys during a short attack, it creates a massive divergence between the public narrative of impending doom and the internal confidence of the people actually running the books. This tension is exactly why SoFi is currently one of the most discussed names across online investing circles. If you look at the trading volume, it tells a story of intense accumulation and distribution. On the day of the short report, volume exploded to over 157 million shares, which is nearly triple the daily average. This indicates that big players are repositioning. Some are running for the exits, terrified of Enron-esque comparisons, while others are viewing this as a generational entry point for a company that just reported its first ever $1 billion revenue quarter. The market is effectively asking, do you trust the short seller's forensic accounting or the CEO's checkbook? This is the kind of environment where individual brokerage accounts can see massive swings, and having the right investment help is crucial to stay grounded. It's easy to get lost in the noise of the daily price fluctuations, but we need to look at the institutional activity to see where the smart money is actually sitting. Despite the recent price drop, SoFi remains a favorite for those using the SoFi Active Investing platform and various other investing sites because of its one-stop shop appeal. The company recently added a record 1 million new members in a single quarter, bringing their total to 13.7 million. That kind of growth is almost unheard of for a traditional bank, yet SoFi is trading at a valuation that suggests the market is deeply skeptical of its long-term lending margins. This creates a fascinating setup for those involved in self-investing. If the Muddy Waters allegations prove to be a nothing burger, the coiled spring effect on the stock price could be significant as short positions are forced to cover. The broader fintech sector is feeling the heat. When you compare SoFi to peers like Lending Club or Upstart, the divergence in business models becomes apparent. While those companies are struggling with inconsistent loan volumes, SoFi has pivoted hard into being a nationally chartered bank. This gives them a lower cost of capital through member deposits, which now exceed $20 billion. This is a massive structural advantage that many critics overlook. They see the Fintech label and assume the company is just a middleman, but the reality is that SoFi is increasingly becoming the infrastructure for the modern financial system. Their technology segment, often called the AWS of Fintech, provides the back end for major players, including some names you'd find on the Robinhood app or through interactive brokers trading platforms. When we talk about online investment in 2026, we have to talk about the shift toward holistic financial management. SoFi is betting everything on the idea that if they can get you to open a checking account, you'll eventually take out a personal loan, use their SoFi robo-advisor, and maybe even trade some crypto on the same app. This cross-buy strategy is working. 40% of new products are now opened by existing members. However, the market is currently punishing them for the very thing that makes them successful: complexity. Investors hate complexity when there's a hint of accounting scandal, and that is exactly the reality that is currently suppressing the expectation of a breakout. Let's get real about the risks for a second. The Federal Reserve has signaled they might only cut rates once in 2026, which is a far cry from the aggressive easing the market was hoping for at the start of the year. High rates are a double-edged sword for SoFi. On one hand, they get better net interest margins on their loans. On the other hand, it puts immense pressure on their borrowers and increases the risk of defaults. If we see a spike in unemployment or a broader economic cooling, those record-high loan originations could quickly turn into a liability. This is why you see such a high level of short interest. The bears aren't just betting against the management, they're betting against the American consumer's ability to keep up with debt in a higher-for-longer environment. Institutional activity shows a mixed bag. We've seen some executives selling recently, like EVP Kelly Keough selling about $165,000 worth of shares, though that was under a prearranged trading plan. Still, when retail investors see insider selling headlines right after a short report, it fuels the fire. You have to be able to distinguish between a scheduled tax-related sale and a run-for-the-hills exit. This is where using professional-grade tools like the Interactive Brokers platform or deep-dive research from Fidelity Wealth Management can help you see through the fog. The data shows that while some insiders are trimming, the core institutional ownership remains relatively stable, suggesting that the big money is waiting for the Q1 2026 earnings call to see the actual numbers before making a definitive move. To understand where we're going, we have to look at what SoFi is today. It's no longer just a student loan company. That segment, while still growing, is being eclipsed by personal loans and a burgeoning home loan business that nearly doubled year over year. They've also made a massive play into the crypto space, launching their own stablecoin, SoFi USD, in partnership with MasterCard. This is a bold move toward integrating blockchain into everyday payments, and it's something that competitors like Fidelity or Schwab are watching closely. The goal is to create a closed-loop ecosystem where money never leaves the SoFi environment. If they pull it off, the fee income alone could make the current stock price look like a clerical error. However, the financial engineering label is a hard one to shake. The critics argue that by marking their loans at fair value instead of holding them at cost, SoFi can create profit on paper before a single dollar of interest is actually collected. SoFi's defense is that as a bank, they are subject to rigorous oversight by the OCC and the Fed, making Enron-style fraud almost impossible to hide. This is the central conflict of the SoFi stock narrative. If you believe in the regulatory guardrails of the U.S. banking system, you likely see the short report as a gift. If you believe the fintech world is still the Wild West, you're likely sitting on the sidelines. I want to hear from you on this because the sentiment is so split. Comment below how many shares of SoFi you currently hold, or if you've actually sold your position because of the recent short report. Are you buying the dip with Anthony Noto, or are you waiting for the dust to settle? Looking at the future outlook, the next few months are going to be a gauntlet for this company. The Q1 earnings report, likely coming in late April, will be the most scrutinized in their history. Management has guided for net income to grow by 72% for the full year 2026. That is an incredibly bold forecast in the face of a short seller calling them a house of cards. If they hit those numbers, the shorts will be forced into a massive squeeze. If they miss, even by a penny, the market will likely assume the Muddy Waters report was right. This is a binary setup, and it's why the stock is a favorite for high-risk traders on the Robinhood app. For those focusing on long-term online investing, the key is to ignore the noise and watch the member growth and deposit figures. As long as people are moving their paychecks to SoFi, the company has a future. The technology platform, including Galileo and Technisys, is also a hidden gem. It's currently growing at a slower pace than the lending side, but it's high-margin, recurring revenue that isn't tied to credit risk. In the long run, this AWS of Fintech could be worth more than the bank itself. But again, that's the expectation. The reality is that right now, the market only cares